The market is now open in what is going to be a massive week right across the board. Now we can see pretty much mixed results. However, our focus today is going to be on the real estate industry, and we can see year to date pretty much some strong performances, nearly double-digit increases from every single one, and why this week is going to be very important as well for the REIT industry. But as we can see, the Federal Reserve is highly anticipated to give a interest rate cut. Now, in terms of whether that will be 25 basis points or 50 basis points, what is clear is that we will see a cut this week. And what we have here is the fact that traders are anticipating that the most likely outcome is going to be a quarter point cut, although we can see 41% is also anticipated in terms of the half point. So whether it's 25 or 50, what is clear is that we will see an interest rate cut. And one thing that we like to focus on when we do look at REITs is how they've performed historically. And what we note here is that they have outperformed after the Fed has finished increasing those rates. What we can see, in fact, over the next quarter from when we see interest rate cuts, real estate in blue has outperformed, in fact, not just over the next quarter, but over the subsequent 2 and the subsequent 4. So now that is why we are really drilling in to essentially this industry. And we also want to point out towards the end of the episode, we will have a very quick analysis on VNQ for those that prefer to have exposure through an ETF as opposed to individual stocks. Now, the first one we're looking at is the monthly dividend paying company, that is Realty Income, where we get a buy rating right across the board from Seeking Alpha, Wall Street and Quant. Remember, with interest rates starting to cut, those who have a lot of money on the side, whether it's saving accounts or in any other accounts, may start to move their money where the interest rate has lowered into these high yielding companies like Realty Income. And as we can see today, this yields just over 5%. Bear in mind, for this company, they pay dividends on a monthly basis, and the P to FFO, referring to the funds from operation, sitting at 14.9. Now we're going to compare that shortly to the sector as well. Now they do currently trade at the upper end, if not right there towards their 52-week high, and over the last year they are up 17%. Bear in mind, this doesn't include if you were to have reinvested your dividends, so that would be up marginally higher. Over the last 10 years, same applies, they are up only around 51%, and when we look just before COVID, we do in fact note February 2020, they were trading at $82. Now they haven't hit that point just yet. It will be interesting to see over the next year or two when rates come down, whether we will see Realty Income not just hit the $82 mark, but in fact make new all-time highs. Now, how have they performed in terms of their latest earnings and future projections? Well, quarter 2 that we heard not too long ago, they did have a marginal beat, but we also note 2 misses over the last 4 quarters, so a 50% track record. And as noted by future expectations, they are anticipating increases to that FFO over the next few quarters, ultimately bringing that forward P to FFO to around 14.2. Now, for each month, we will touch upon their dividend safety score. Realty Income sitting at 80 safe, which is always great, especially a monthly dividend payer. And we do note over the last full year, a 3% increase. Just as a reminder, on this channel, ideally 4%, just to keep up in line with inflation. And what this means, well, firstly, it was reaffirmed just a few weeks ago that the dividend is safe, and it therefore means the dividend cut for Realty Income is unlikely. Now, very important in terms of some key metrics, focusing on the last recession, in fact, Great Recession 07-09, they increased the dividend, they had above average growth, negative 0.8%, again, for those that don't know, S&P was around negative 12, and they also marginally outperformed, negative 43%, as we can see the S&P negative 55. As we mentioned, we want to see ideally 4% or more. That is what we get over the last 20 years, which is nice. You're getting a monthly yield currently just above 5%, and we can see a marginal increase over the last 20 years above inflation. And we also note 29 years of consecutively increasing the dividend, giving them that dividend aristocrat status, which entails a company to have increased the dividends for 25 years or more. And we can see here 55 years of paying a dividend without a reduction. Now for each company today, we're going to look at dividend yield theory, and this states a company is undervalued when the current yield sits above the 5-year average. So we have our first sign of undervaluation. In fact, we can see based on the forward P to AFFO lower than the 5-year rolling of 17.3, we have a double undervaluation signal, and it is marginally lower than real estate, so you could argue triple undervaluation signal for Realty Income in today's episode. Now, very important to look at the payout. It does make up some of that information in terms of the dividend safety. And whilst we do like to draw your attention to the free cash flow payout, for REITs, a lot more volatile. So we look at the adjusted funds from operation, where we want to see below 90%. That is what we get for Realty Income, also decreasing over the last 10 years, 76 in 23, 74 over the next 12 months. So that dividend does look to be very good. The payout does look to be very strong as well, well below that 90%. Then in terms of AFFO per share, similar to free cash flow that we look on the channel, we want consistent increases over the longer term, something we see with this company, $4 in 23, $4.27 expected over the next 12 months. And for those that do like to see this on a percentage basis, well, we can see over the last 10 years around the 2 to 9%, with 4% anticipated over the next year. Then we get to the sales growth, 5 to 10% for REITs, moderate growth. They've pretty much smashed that every single year, 22% in 2023, but we also need to make sure that the AFFO is growing at a strong rate, and ultimately when we do look at the shares outstanding, that the dilution isn't at a very rapid rate. Now what this ultimately tells us, remember with shares outstanding on typical companies, we want them to do share buybacks, returning the excess cash to investor pockets. However, now with REITs, because they retain a little of that internally generated free cash flow, we do see them dilute your position over the longer term to effectively fund any property acquisitions and any other expenses. Bear in mind, Realty Income is one of the REITs that does it at a fairly rapid rate. We can compare it to others today, but just something for your own consideration. And when we do look at the total sales, around $1 billion in 2014, $4 billion in 2023, so that is in fact more than 4 times 10 years ago. And with their recent acquisition of Spirit Realty, hopefully we will see a larger increase in some of their metrics. ROIC then, 3 to 5% is what we want for REITs. Give us faith that management are able to effectively allocate their capital. 4% looking consistently 2014 to 2020. It did drop to 2%. Nice to note the increase over the last 2 years, but ideally we want to see it around the upper end 4 to 5, which they have done over the longer term. Then we get to the margins, around 50% consistently over the last 10 years, so that does look to be positive, especially with the other metrics like the sales increasing. And then we get to the net debt to EBITDA, which is very important for REITs, especially those that do pay on a monthly basis like Realty Income. And below 5.5 is what we want to see. Given the numbers below do tell us the number of years it would take the company to pay off all of their debt net of cash on hand. This metric therefore correlates to both dividend safety and balance sheet strength. 6.05 in 2023, so that is above what we want to see at a bare maximum of 5.5. Nice to note, over the next 12 months, anticipated to come to 5.18. But again, this is under the expectation they can hit their targets and their projections. So overall, the dividend, as we did see, does look safe with the score of 80. Now let's jump into the valuation model. And as always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now our intrinsic value of $68, we got this by running it through 3 models. Now typically on this channel, we do deep dives of each company. We go through each model input and output. We're going to jump straight to it today, and with the intrinsic value of $68, not far off Wall Street's $67.50, they indicate 8% upside. Now when we take a look at margin of safety, very important, we start with a minimum of 10%. We execute on this if it hits our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Now today's episode, Realty Income isn't far off a 10% MOS, and whilst we see minimal upside with Wall Street of 8%, bear in mind a few things with this company. Income investors will like this a lot, those who use the income, the dividend, to pay for their expenses, but also you are getting a yield at around 5% or marginally higher, which is likely to be a lot higher than these savings accounts, especially when we do start to see those rate cuts. And as we saw from historical data, REITs will outperform. A lot of people will bring their money into companies like Realty Income and the ones we will show today. But as always, do give us your thoughts below. Is this one you're accumulating, maybe one you've stopped, or maybe it isn't one you're looking at all because it doesn't fit your overall thesis? Before we move on as well, just to run through a few more percentages, at the 15%, an acceptable buy at $58, at 20% around $55, and at 25% around $51. However, as we said, near 10% today, and as always, you can grab a copy of this model by clicking on the pinned comment below to run your own numbers, whether it's for Realty Income or any others. We also want to let you know we have released our latest free weekly article. If you want access to this or any others, you can click on the pinned comment below, read and sign up straight away. You can also take a look at 25 undervalued stocks we have looked at for your consideration for the month of September, where we also run through each one that sits within our own portfolio. And you can also grab a copy of this where we've looked at 22 dividend stocks that have the most upside according to some Wall Street analysts. So do go ahead, check them out by clicking on the pinned comment below. The next REIT we'll look at is Alexandria Real Estate ARE with a double buy and a hold from Quant. This one is trading at the upper end of the 52-week range with a forward yield again fairly attractive, 4.2%, P to FFO of just above 13, and similar to Realty Income, up around 12% over the last year. Over the last 10 years, up around 65%, and we can see it hasn't recovered from the drop of its all-time highs, sitting around the $223 mark in December 2021. Now, when we take a look at their earnings, well, the last two they did beat, but as we can see a miss, they have a 75% track record. Nice to report the next 4 quarters anticipating increases to the FFO, ultimately bringing down the P to FFO in December 2025 to 12.88. Now we report another safe dividend score of 76, and we can also see an above inflation increase over the last full year at the 5% point. Now in terms of the last recession, we note that they did in fact cut the dividend. They had above average growth, negative 5.7, but they did also trail the S&P, negative 68, and we can also report over the last 5 years, 6% increase to the dividend, over the last 20 at a bare minimum, keeping up in line with inflation, and they can report 13 years of consecutive dividend increases. Now, in terms of dividend yield theory, again, we're reporting another severe double undervaluation signal, both on the yield as well as the P to FFO. In fact, the yield currently at 4.18 is significantly higher than the 2.76 we have seen over the last 5 years. And we do also note the real estate as a whole does sit only marginally though lower at 15.3. Now when we take a look at the payout ratio, again, we want to see below 90%. No worries here whatsoever for ARE, consistently below that, and 66% projected over the next 12 months. In terms of AFFO, whilst it may not be consistent over the longer term, we still get increases over the last 10 years, and that is expected to continue over the next 12 months to around $7.85 per share. We do have to point out though, in terms of growth, there have been 2 years where it has been double-digit negative, but over the last 2 years looking positive, and double-digit 13% expected over the next year. Also, no worries whatsoever with that growth to their top line, double digits pretty much every year, 11% in 2023. Again, no issues with their top line, similar to Realty Income, quadrupled over the last 10 years. But again, unfortunately, similar to Realty Income, they would have diluted your position over the last 10 years. Again, something that we have said is very, very common in this industry. We also note the ROIC a little bit lower, around 2% over the last 4 years, ideally really 3% at a bare minimum, but as always, this is why we do like to incorporate our margin of safety when we look at it from a valuation perspective. Operating margin looking fine as well, around the 20 to 30% year on year, currently at 27% on a trailing 12-month basis. And then when we get to the net debt to EBITDA, a reminder, below 5.5 is what we want to see, pretty much straddled above that year on year, 5.95 in 23, anticipated marginally higher over the next 12 months. So this is the reason why, like Realty Income, we don't see a very safe dividend score and just ultimately that safe score of 76. Now, in terms of the valuation, our intrinsic value of 143, it is marginally higher than Wall Street. They have 136 with upside of 10%. And when we look at it in terms of the MOS, well, at 10%, a buy at 129. At 15%, it isn't quite there yet, although around $2 shy. So you could argue in today's episode for ARE near a 15% MOS with upside of 10%. And as a quick reminder, we have seen through historical data that REITs will outperform. So do give us your thoughts whether or not you have been previously adding REITs to your overall portfolio, or maybe now with interest rate cuts looking very, very likely, this is an industry you are considering adding as a percentage of your overall portfolio. We then move on to Rexford Industrial with a strong buy from Seeking Alpha, a buy from Wall Street, and a hold from Quant. This one trades pretty much bang in the middle point of the 52-week range with a yield of 3.3%, a P to FFO of 21.4, and has, unlike the previous two, decreased over the last year, down 2.6%. And when we look over the last 10 years, unlike the previous two, has significantly outperformed the S&P, up 262%, although we do know it is a little bit away from all-time highs 2 years ago of $81. Now, nice to report, over the last 4 quarters, they've either been in line or beaten analyst targets, so 100% record, and expectation over the next 4 quarters looking positive, ultimately bringing down that forward P to FFO to 19.4. We also can report our first very safe dividend score at 81, although this is only 1 point above Realty Income, and very nice to see 9.9% increase to the dividend in February this year. When we take a look at dividend growth, well, over the last 5 and last 10 years, double-digit increase on average year on year, very, very impressive, with 10 years of consecutive increases. Then when we do take a look at dividend yield theory, we get again another double undervaluation signal, both on the yield as well as the forward P to AFFO, but we can in fact see Rexford does trade at a premium to the overall sector, which sits at 15.3. Then when we take a look at the payout ratio, consistently below 90%, 88, so a little bit high in 2023, but coming down to 83 anticipated over the next 12 months. And when we look at the AFFO, very nice to report, pretty much consistent increases on a year-on-year basis. That isn't expected to change, with an increase anticipated to $2.01 over the next 12 months. When we look at it from a percentage increase, pretty much a double-digit increase every single year, 7% in 23, 8% over the next 12 months, with sales growth again looking very strong, double digits, 26% in 2023. In terms of total sales numerically, well, they have been growing more than 10 times over the last 10 years, so very rapid growth, 798 million in 2023, but again, very similar, dilution of your shares is something that we do have to remind you is very consistent, but ultimately it is good to see that they have outperformed the S&P over the last 10 years. Now, whilst 1% is very poor in terms of ROIC, nice to note it has been increasing, and for the first time over the last 10 years, we see 3%. As always, the minimum we ideally want to target, and hopefully they can continue the upward trend, showing us 4 to 5% over the next few years. Margins looking very good as well. Operating efficiency through the increase of the margin from 11% to 37% in the more recent period. And then when we get to the net debt to EBITDA in 2023, 4.06. Over the next 12 months, even with the increase anticipated, we can still see it is below that maximum. So it does look good. Understandable why we get our first very safe dividend score. Now, in terms of the intrinsic value, we have $64. It is marginally higher than Wall Street. Their target of 57 does give us 12% upside. And when we run it through the intrinsic value and the MOS calculation, 10% MOS, a buy around $57, $58. At 15%, a buy at $54.30. At the 20% mark, around $51. But today's episode, not quite at the 25, more sitting around 20% MOS with upside of 12%. And if you do like dividend growth, as we have historically seen, they do offer very nice increases on a year-on-year basis. But as always, do give us your thoughts below. We then move on to Prologis, where we get a double buy and a hold from Quant. This one is trading in the lower end of the 52-week range with a forward yield not far off 3% and a P to FFO around 24. Over the last year, not the greatest, 6.66% increase. Over the last 10 years, however, similar to Rexford Industrial, outperforming the S&P up 240%. And we can see all-time highs over the last 52 weeks, around $240. Now, in terms of their growth and expectations, well, last 4 quarters, they have at least been in line or beaten. Moving forwards, though, we can see some very nice increases anticipated, lowering that forward P to FFO to around 21.9, but again, will depend on whether or not you have faith management can hit those targets. Now, we do get another safe score of 61 and a very nice double-digit increase in February this year of 10%, very similar to the previous stock. And when we do take a look at their key metrics, while they cut the dividend, they had negative 80% sales and they massively trailed the S&P, something to bear in mind if you do believe we are entering into another recession soon. Over the last 5 years, double-digit growth, although given the cut, we can see on average over the last 20 years, it is 0% growth, and we can clearly see from this graph, they did have quite a few cuts during 2008 to 2011. In terms of the growth streak, though, currently does sit at 10 years, whilst they have been paying a dividend for the last 12 years without a reduction. Then when we take a look at dividend yield theory, very similar to all of the stocks today, all of the REITs, we do get that double undervaluation signal on both metrics, although we do have to note, similar to Rexford Industrial, Prologis does trade at a premium to the real estate sector. In terms of looking at the payout ratio, well, for industrials, we'd be a bit more specific, around 75% as a maximum. Whilst we see that in 2023, do note there is anticipation of an increase to around 81% over the next year. And then when we get to the AFFO per share growth, whilst we do see increases from 2014 to 2023, we do see a small drop expected over the next 12 months to around 473. In terms of percentage wise though, we can in fact see whilst it has looked strong over the last 10 years, 2023 negative 1% drop. However, over the next 12 months, nice mid to high single digit of 8% anticipated, with no issues whatsoever for their top line growth, nearly double digit every single year. And when we do look at it, we can in fact see, similar to the first 2 REITs, they have quadrupled their top line from 2014 to 2023. But again, also very, very similar to every single stock today, they have in fact diluted your position as a shareholder. But similar to Rexford, Prologis has outperformed the S&P over the last 10 years. Very consistent in the ROIC, pretty much 3 to 4% year on year for the majority of the last 10. And then when we get to the margins, we do see some small signs here of operating efficiency, with margins going up on a year on year basis, something we like to see as part of our criteria for high quality companies. Increase to top line revenue as well as increase to margin. We also like the trend of the net debt to EBITDA, which has pretty much been decreasing over the longer term. Still a little bit high at 5.23, above the 5 we want to see for industrials. Nice to note, over the next 12 months anticipated to come down to around 4.8. Now, when we get to the valuation of Prologis at $139, pretty similar to Wall Street of 138, they see upside of 7%. And when we run it through the MOS, well, at 10%, a buy at 125, 126. Again, not far off, so you could argue Prologis, which is one of the largest REITs, has a 10% MOS. Upside fairly minimal at 7%, but again, if you are looking for those dividends and you do believe with interest rate coming, then REITs will be a massive benefactor, then these REITs could be one to take under consideration. As always, do give us your thoughts below, and as we said, if you are looking for just exposure over the REIT market as a whole, then you could look towards a VNQ, that is the Vanguard Real Estate ETF. Now, one thing to point out, the expense ratio does currently sit around 0.13%, so maybe something to consider for those that do have a few ETFs either in mind or that sit within their portfolio, just for some consideration. And for those that want to know their top holdings, well, we can see the first one is in fact Prologis that we just took a look at, and we can also see Realty Income also sits within these. Now, Prologis makes up around 6.7%, so if you do like that company as a whole, you will get exposure through this ETF, as well as Realty Income, which as we can see, 3.06. Now, we didn't run through the top 10 as a whole, but these are quite a strong list of REITs that maybe it is worth just taking a look at. One that we have reviewed many times that has historically looked very strong is Equinix as well, around 4.3% of the total portfolio for VNQ. And before we end the episode, in terms of how it's performed, well, we can in fact see year to date it is up around 20%. As we said, for the overall REIT market, it has looked very strong, something we do believe will continue when interest rates take place, but we can see over the last 3 years, the average return has been pretty much flat over the last 5 around 4.5%, over the last 10 years at 6.3%, and since inception around 7.9%. Again, will completely come down to your overall investor thesis, your portfolio, and your strategy, as well as ultimately your time horizon for how long you want to have companies in a portfolio. As always, if you enjoyed today's episode, value was provided, smash that like button, hit that subscribe and bell button. Also, don't forget to sign up to the free weekly newsletter and come and join us in the Patreon where we do talk about our weekly buys and sells. As always, have a great day and we'll see you all on the next one.